Today we're going to be talking about investment basics. So by now, we know that there's a path to financial freedom. That the first thing is that you need to have your financial basics in place. And essentially, that means your income more than your expenses and no debt. We then know that we need to put our financial protection mechanisms in place. Once you've got out of debt, one of the most important things that you can do is to get a cash flow account to smooth the month-to-month expenses and also an emergency fund of at least 3 months worth of expenses. Then we need to look at financial independence, and that's making sure we have enough money either invested or in income that we can control that can create an income that matches our basic needs, a house to live in, food, and basic transport and other needs. And then we look at financial freedom. In order to start investing, you need to have your vision, a very detailed plan of retirement, because in order to answer the question of how much do I need, you have to know whether you are wanting to live in a tiny house or in a huge, big, fat New York City apartment. Then you need your basics in place. You need to make sure that you have no debt and that your income is more than expenses so that you can start investing. Then you need to have a target. How much do you need? And we discussed the fact that in low inflation countries such as America or the United Kingdom, you need your monthly expenses multiplied by 400. So if you have $1,000 of need, you need $400,000 of money invested. In higher inflation countries such as South Africa, you need your monthly expenses times 300. So for every 10,000 Rand of monthly expenses, you need 3 million Rand of invested assets. And then you need to understand your timeline. When do you need this money by? How far is retirement for you? So the key fundamental basis of investment is this trade-off between risk and return. That you can put your money in the bank or in a money market account and you will get a low return, which is on this side, but you will also have a low risk. However, if you invest in something like private equity, very risky, you expect a much higher return, but a much higher risk too. So risk and return are a trade-off. And risk for many people is, am I going to lose my money? Investment people have a whole bunch of definitions of risk. But for us normal human beings, the risk is, am I going to lose my money? So it's important that each of us understand our risk tolerance. Risk tolerance essentially has 4 factors: time, need, tolerance, and capacity. And for the first and most important place to start is time is either your friend or it's your enemy. It's fascinating because I was looking at our personal finances the other day, and 26% of the assets that John and I have came from before we were 30 years old. That's just time. It's not that before we were 30 we earned an inordinate amount of money. We didn't. It's just that over time that money has invested and grown. So time is either your friend or your foe. And one of the things that time does is it changes the dynamics of investments. So if your money is in cash in a bank, it's low risk and it might have a low return of 2%. But if inflation is 6%, your cash is actually a very risky strategy over the long term. Why? Because your money will buy you less in 10 years' time than it buys you now. So this is a well-known illustration of the value of time. And it shows Susie, Bill, and Chris. Now, Susie invests from the age of 25 to 35, $5,000 per year. So in total, she will have invested $50,000, 10 years times 5,000. And then she doesn't invest again. And what happens is that her money just continues to grow. Bill invests $5,000 a year from 35 to 65. So in total, he invests $150,000. But you will see that he never, ever makes it quite up to the level that Susie's at. And the reason is this point over here. At 35 years old, Susie has a lot more in the market that she starts from a higher point, and then she earns interest that is compounded. And interest essentially is free money, and compound interest essentially is free money on free money. And so this whole compounding means that she finishes in a better position, having invested 1/3 less of actual physical money out her back pocket. Now, Chris invests the whole way through. So although he only invests $50,000 more than Bill, he ends up with more than double. So he only invests 1/3 more, but he ends up with at least double the amount of money. And that's this element of time. This graph shows the returns on the Johannesburg Stock Exchange for 54 years worth of data. In a 5-year period, the lowest return that someone has ever had per year is 0.5%, but the highest return is 46%. So basically what it says is if you're investing for a very short time period, a 5-year time period, you have a massive range that you could possibly get in terms of the return on your investment. However, once you get to 10 years, that range narrows, and it narrows to basically 6% to 37%. And it goes on until at a 40-year period, you roughly have certainty that you will get somewhere between 16% and 20% return. So what essentially happens is that the factor of time narrows the risk and uncertainty of the return. So that's why cash is a safe and better bet for a short period of time if you are risk averse. But as I said, if your cash is only generating 2% and your inflation is 6%, it's actually a high risk strategy over a long period of time. Similarly, if you don't need money, your risk and your return profile narrows over time. So time is hugely important to understand when making your decision. How long will you be investing this money for? The next factor in terms of risk is need. And the risk need basically describes how much risk do you need to take because you need a bigger return. So let's illustrate this in a little graph. Let's say that this is person A. We look at person A and we work out what they have now and what at a certain growth rate that'll be when they retire. We work out what they'll contribute based on today's assumptions, so we don't take anything besides their current existing contributions, and what those will be worth when they retire. And then we work out what they need. And we work out that this person has a certain gap that they need to fill with more contributions every single year. Now, person B has the exact same need, the exact same time, and the exact same contributions, but they have less money today. So they have a bigger gap. So if both those people were to reach the finish line with the right amount of money, this second person would need to take more risk to get more return to close the gap. So that is the challenge of the risk you need to take. So having looked at time, how long you have, need, what risks you need to take, let's look at your risk tolerance. And this is for each person very, very, very individual. And it's a measure of how much you're willing to let your portfolio dip for the chance of above average returns. The more risky the assets you have, the more they bounce up and down every single day. If we take cash, you know that every single day you'll earn a little bit of money at a certain rate. It doesn't bounce. However, if you take shares, and especially offshore shares, it's going to bounce all over the place, up and down, depending on the exchange rates, depending on the shares. The reason why risk tolerance is important is this. We have a concept in behavioral economics called loss aversion bias. And basically what that means in human language is that it has been proven that people experience the pain from loss double the pleasure from gain. So if your investment loses $1,000, R1,000, you will feel that twice as much as if your investment gains 1,000. And trust me, I see this all the time, and particularly in sensitive clients such as retired clients. If the market drops a tiny amount, they feel the pain significantly. They never truly celebrate the market moving upwards. And basically why this is important is that there is this investor sentiment or investor emotional cycle, and it's essentially based on FOMO. So what happens is as the market's rising, and if you take the recent Bitcoin movement, it's exactly that. As this thing rises and doubles and triples, everyone goes, oh my goodness, I'm going to miss out on this. So what ends up happening is that they then buy. And then it gets to the highest and everyone feels great. They think that they are rocket scientists and that, you see, it was good that I got in because it's still, my investment has grown. And then the first time the market tries to dip, what people then tell themselves is that, don't worry, it's just a correction in the market. It's going to go back up again. But as that market continues to dip, people panic. And what happens is that they then sell. And as this comes down, people then are selling. So what they ended up doing is buying high and selling low. By now, when the market is really at its bottom and they have extreme negativity and bad sentiment, they are all sitting in cash. And as the market starts to turn again, they hit FOMO. Now, why this is hugely important is that people generally tend to buy high and sell low. So if you take the performance of a fund over a long period of time and the returns that investors have got, generally the fund outperforms the returns investors have got. And the only reason why is because the fund stays invested in itself and investors jump out and then they get back in when they are hitting this FOMO cycle. And in the last 5 years, particularly in the South African market, the market has been flat. And what has happened is that people have all moved into cash. And the challenge with that is that you can't time or know when the market's going to start rising. For 20 days over a 20-year period, if you hadn't been invested in those 20 days, you would have missed out on half of the returns. And that's the challenge, is that nobody can perfectly time it. The other thing is this difference between what we call paper losses and actual losses. So if I over here spend 100 Rand and I sell over here for 70 Rand, I physically lost 30 Rand. I have 30 Rand less money than in real terms. However, if it's 100 over here and 30 over here and I'm holding and it goes down to 50 over here, and then it goes up to 75 and then it gets back up to 120. When I'm down here, it's not a realized loss. I haven't actually what we call locked in that loss. It's a paper loss because I physically haven't sold the share. So yes, it's worth less, but as I hold on to it, it'll be worth more. And that's what happened when people panic and they sell out, is that they end up what we call locking in that losses. And when they buy again up here, back in FOMO time for 100, but they sold for 70, they've actually, when they go back again, only have 70 to put back into the market. And that's why people lose money over time. And it's exceptionally difficult as an advisor to advise people not to sell because they are intent and driven by these emotions. Why? Because they feel the loss double as badly as the gain. So lastly, the last factor is capacity, your risk capacity. And that's essentially is an easy example to describe, which is that if you have 100 million Rand and you only need 10 million Rand, you can afford to take a risk and lose some money. However, if you need 10 million Rand and you only have 1 million Rand, you can't afford to lose money. So you can't afford to take so much risk. So before you start investing, you need to be very clear on you and these 4 factors. You can test risk tolerance. You know the time that you want to retire. You understand the return that you need in order to meet the finish line in time. But you must also understand your capacity. And the worst thing is to mismatch your portfolio. So if you put a client in a high risky portfolio that has a low risk tolerance, every time the market drops, they're going to have a heart attack. If you put a client who has a high risk tolerance and risk capacity and they can take a lot of risk and you put them in a cash account, a lot of the times they're going to be really cross with you because they have such bad FOMO of the returns they could have got. So be very clear on where you fit within these 4 factors. In the next session, we'll then look at starting to actually invest.